Well, hey, welcome back. Today we're going to be talking about how to borrow money for investment property. So if you're a real estate investor or you want to get into investing in real estate, chances are you want to know, how do I come up with the money to buy these properties? Maybe you weren't born with a silver spoon in your mouth and you need a little bit of help when it comes to capital and raising money for buying properties. Well, today that's what we're going to talk about in this video. We're going to talk about the difference between debt financing and equity financing. We're going to talk about traditional lenders, hard money lenders, private lenders, and a few options as well. So stay tuned. All right, so one of the first things we want to look at when it comes to finding the money to finance your investment property is the difference between debt financing and equity financing. So what are they and what is the difference? Well, debt financing is where someone or something loans you the money and you have to pay it back with typically a specific interest rate. So for example, a traditional mortgage on a property, that is debt financing. The bank finances the property, you pay them back over time with a specific interest rate typically, all right? So what is equity financing? Well, equity financing is more like you bring somebody on as a partner with you in that deal, and they get a percentage ownership or a percentage equity in that property. And their returns are typically based on the profitability of the deal, not on a specific interest rate. So debt is a specific return on investment that the lender is getting for loaning you the money. Equity is they're getting a piece of the pie and they're getting a piece of the profits on the entire deal. That's the big difference. All right, so now let's take a look at some of the sources of financing for these kind of investment properties. And the first one, and the most common, is traditional financing through the big banks. So this is through banks and credit unions, type A lenders. And this is what most of us think of because it's the normal way mom and pop home buyers buy their houses, buy their personal residences. So we're really accustomed to this. If you're doing single family homes, even if you're doing multifamily properties, these kind of traditional lenders tend to offer the lowest interest rates, the most affordable money to borrow, typically, all right? Not always, but typically. Now, the challenge is that they're pretty fussy. They're pretty persnickety about the kind of people that they're going to lend money to and the kind of properties that they're going to loan money on as well. So this is where you have to jump through a lot of hoops, especially if you're looking for purchasing a single family home or residential real estate. They're going to take a really hard look at you, your income, your personal credit rating, your personal financial situation, because they're going to look at you as the primary backing for the loan. Okay, if you're getting financing for a multifamily property, then they're going to take a look at you, but they're going to look a lot more at the property itself and how profitable is it, how much cash flow is it generating, and what are the opportunities there. So again, traditional lenders are typically very, very conservative, so it's going to require a lot of qualifications to get you and or your property lined up for financing through one of these kind of lenders. Now, what kind of a loan is this? Well, this is typically a debt kind of a loan, right? They are loaning you money and you are paying them back with a specific interest rate on that loan. So this is typically debt financing. Another source of funds to borrow for buying your next investment property could be hard money lenders. So what is a hard money lender compared to a traditional lender? Well, a hard money lender is more like, instead of a bank, it's more like an individual or a small company that makes loans professionally, kind of like a real estate loan shark, right? So they are typically less fussy about you and your personal financial and credit situation, and they're going to look a lot more at the property itself and make sure that there's a big cushion there. So should you default on that property, they can go grab it, they can foreclose on it, they can get it turned around, sold, and get their money out and cover their expenses as well. So that's what they're really looking at, not you so much, but more at the deal. And typically, again, these are debt type loans. They're loaning you money for the property. The collateral is the property itself, but they aren't owners on title. They are getting a fixed return on their money. And typically, it's a very high interest rate compared to traditional financing, and they might even charge points up front or at the end on the amount of the loan as well. So these are professional money lenders. They're looking to get a very good return on their money, and typically for shorter term loans. So this is really good for if you're doing a flip or you're doing a BRRRR and you're going to be getting the in and out of the property in less than a year, then this could be a very good option for you. If you're looking at borrowing money for a year or longer than a year, then typically, if at all possible, try to get that through more of a traditional bank or something like that. But again, this is another option for you, and this is typically debt financing. All right, the next source you can look at to borrow money for an investment property are private lenders. So private lenders are a little bit different than hard money lenders. They typically are individuals. It's not usually a company per se. They are individuals who don't make their full-time income from loaning money. It's more like a side investment for them. So this could be somebody that you know, somebody that's in your network, and perhaps you borrow their money from their home equity line of credit or their retirement funds or something like that, and you invest it in your property. And the nice thing about this is there's a lot of flexibility. So with private lenders, you can typically negotiate a win-win scenario with a much lower interest rate than it would be with a hard money lender. They typically tend to be a lot less fussy about looking at your personal financial situation, and they tend to be a lot more flexible as well because you're dealing directly with them and this is not their main business. So this is another great source, and depending on how you do it, it could be either a debt situation where they're just loaning you the money and they've got some sort of their interest registered on title, perhaps in a second mortgage or a lien on the property, or even just a promissory note, and you're paying them back a specific interest rate over time for a specified amount of time. Or in some cases, you might bring them on as a partner and they are actually on title on the property. They bring in the capital and you share the deal. So the good thing about that is you don't have to be paying them a fixed return on their money. So if you're in the midst of doing a renovation on the property, there's nothing coming in, there's nothing going out in the way of interest payments either. So this is a really good way to lower your risk and potentially help your investors get a higher return on their money as well. Another thing you can look at is raising private money or working with joint venture partners. This is pretty similar to working with private lenders, but again, if you're working with a joint venture partner, they're not just loaning you the money expecting a specific return on that, a specific interest rate. They're partnering up with you. You're joining forces with them. They're coming on board. They're bringing the capital. Perhaps they're bringing the credit and the qualifying to the deal. You're bringing the know-how, the team, the deal itself, the management, and together you're doing that deal. And you're sharing in the upside as well as the risk on that deal. Everybody's going in with their eyes wide open. So you only make money if they're making money. They're only making money if you're making money. So it's in everybody's best interest to make sure that it's a good deal. So again, raising capital, finding your own private investors, your own joint venture partners is a great way to get all the money you need to do all the deals that you want to do now and moving ahead into the future as well. And last but not least, we want to take a look at negotiating the terms of the loan. So this really comes into play once you've got a few deals under your belt, especially if you're working with hard money lenders, private lenders, or private investors and joint venture partners. So at the beginning, if they don't really know you, if you don't really have much of a track record or much experience, you're going to be paying prime top dollar for the money. That's just the way it works. But over time, as you get more experience, as you get more deals under your belt, as you show that you are a good, reliable person to loan money to or to invest with, then you can start to have a little bit of wiggle room there with what the interest rates are, with what the points are, with what the split is if you're doing a joint venture type of arrangement. So for example, I've seen quite a few scenarios where somebody's pretty new to real estate investing. They don't have cash up front to get started with their first deal. So they managed to get a joint venture partner on board, but instead of it being a 50-50 split, they give a lot more of the deal to their partner because they don't have experience yet. They don't have a track record yet. So it might be a 70-30 split or even an 80-20 split at the beginning in favor of the investor. But very, very quickly, once they got a deal or two under their belt, then they say, hey, you know what? We did that for those deals because I was just getting started. Now I've got a track record. Now I definitely know what I'm doing. Now you've got proof of concept. Now we need to take a look at a fairer, more equitable profit split. And that's where you get it more towards the 50-50 range. So it's all about negotiating things. Same thing with your hard money lenders. Maybe at the beginning, they're not quite sure if you know your stuff or not. Prove that you do, and then you might be able to negotiate a little bit of wiggle room there with how much the money is costing you. All right, well, if you like the idea of private capital, especially when it comes to bringing on private lenders or more specifically joint venture partners, I've got a good resource for you. It's my book. It's called The Money Partner Formula. I'm going to give you a free copy in exchange for your name and your email address. You can just go to investorattractionbook.com or click on the link in the description below. And this is going to walk you through step by step exactly what to do and how to do it when it comes to raising private capital. Go ahead, get your free copy today.